Hello everyone, welcome to the first session on the financial instruments. So today we will be quickly go through the basics of the financial instruments, understanding what exactly it is, the financial assets, financial liabilities, and a few other things. And then we will also see some part of the practicalities like certain covenants, like certain terms we will be understanding for the valuation. We will be seeing a part from the accounting and certain part from the valuation. Okay, so let us start. And now the basic idea is like we'll be covering the IFRS 10 or India AS 107, or let me call it as IFRS 7, IFRS 9, and IAS, International Accounting Standard number 32. Okay, these are the three accounting standards we will be seeing for the accounting part. When it comes to the valuation, we will be seeing almost like the valuation, the pricing of the debentures, like the bonds and the debentures, like convertible bonds, puttable, callable bonds, and everything. We will be seeing the income components and everything. So let us start. So this is the same handout. You can just take a printout, or if you want to, or otherwise you can just go through the over your system or in the mobile itself. Okay. Uh, okay. Let me use it in the landscape style. Okay. Then. So this is your handout for the online workshop for the session 1 or the financial instruments and introduction to the financial instrument. Okay. Then in this financial, what exactly a financial instruments as per the IFRS? IFRS says a financial instrument is something that creates a financial asset to one entity and a financial liability to the other entity. So in your books of accounts, in one company's books of accounts, in a balance sheet, if a particular transaction creates a financial asset to one entity and the other entity is booking the same transaction as a financial liability, then it is called as a financial instrument. Okay, so if you see the definition, sorry, financial instruments is any contract that give rise to the financial assets to one entity and financial asset to another entity. Okay, certain examples: accounts receivables, debtors, and all, futures, forwards, option contracts. So we'll be seeing in more detail all these examples. So it should be a financial asset to one company, right? So we should understand what is a financial asset, financial liability, and then what is an equity. Okay, so financial asset, let me try to explain in a blank page. All your financial assets are like cash and cash equivalents, right? All the cash and cash equivalents can be considered to be a financial asset. What is a cash equivalents? It could be your bank balances or your FDs or whatsoever. Okay, and number two, an equity investment. So if you are a company and you have invested in a particular subsidiary, or maybe you are owning some equity shares of another entity, and that equity shares of another entity is a financial asset. Number 3, okay, contractual right to receive. Okay, why? Because fourth point says contractual right to exchange. Okay, third point we're talking receive a cash or maybe receive other financial asset. What is other financial asset? Be it like equity, for example. We already discussed it here, right? Equity. So I'm taking the same example of equity. So a contractual right to receive, from whom we generally have a contractual right to receive. Maybe we have given a loan, so we have a contractual right to receive back the cash, or we have a trade receivable, we have sold the goods or we have provided the services and we have a contractual right to receive the cash from that particular party, trade receivable, debtor. Same way, other financial asset, equity. For instance, you sold a goods to one party, and instead of cash you are asking them to pay it in the form of equity shares of another entity. Say for example, A company, B company, and A company has made a sale to B company, and instead of, they can pay either paying the cash or they can give another financial asset, cash or other financial asset. For example, you say equity shares of C company. Okay, so this transaction also, this is also a financial asset that can be considered in the A books of accounts, in the A company A's. Okay. The other one, the contractual right to exchange. Exchange of what? Exchange of financial asset or financial liability with another entity. What kind of contract it could be? See, let us take a very simple example. The A company and B company has agreed into a share. For example, A company has the Apple share while B company is having the IBM share. On 15th of October, say 15th of October, they agreed that on 5th of November, 5th of November, A company will transfer one share of Apple to B company, while IBM share will be exchanged by B company to A. So A company will be giving one Apple share and B company will be giving one IBM share. Okay. So this will be executing on 5th of November. On 15th of October, say both are more or less at the same price, like $100, $100. Okay. Now we are closing the monthly financials, monthly accounts we are going to close. So it is happening on 31st of October. 31st of October, what has happened? This Apple share have went up to $102, while IBM share is only at $101. Meaning A company is in a better shape, because once after getting this, as on 31st of October, the situation is something like A company is having a favorable situation by $1 excess, right? So they are in the favorable situation, they are in unfavorable situation as on the date of your reporting. In our example, it is 31st of October. Uh, So if a contract for right, a contractual right to exchange financial asset and financial liability, and and in a favorable position. So in this case, for A company, this excess $1 can be considered to be a financial asset. Okay. So this is what the fourth point is all about. Sorry. And then the fifth point we can see, in the fifth point we can see there is a contract for settlement in own equity shares of issuer, will or may. So these are the terms. At variable number of shares. So let's take an example. Sorry. A company and B company, as usual. Let's take this example, A company and B company, so that it will make more easier for us to understand and discuss. B company has issued a convertible debentures. What? Convertible debentures. What they have told, they can, like they have issued at $10 million on 1st of April 2015, say. Now what they said, like these convertible debentures are can be convertible into shares, or it can be paid. It's an option of, it's an option at the time, at the buyer. So buyer has an option, either he can convert into debentures or he can just take the cash and he can get lost. So he can either take the debentures, or who? A company can take either cash or he can accept for the debentures. Okay. Again, what they told, debentures, you have paid me $10 million. So at the time of your conversion, so for example it is happening on 31st of March 2022. Okay. At the time of conversion, this particular A company has two, no, they don't have the choices. Convertible debentures or converted at a fixed number of shares, meaning convertible debentures you have issued 10 million, so each having a face value of 100. Okay. So they have got about say 100,000 debentures A company has got, and for every 10 debentures they'll get 1 share. Okay, for every 10 debentures, they will get 1 share. Meaning, how many they will be getting it? So 10,000 shares, fixed number of shares. So in this case, they will get only fixed number of 10,000 shares. In the other case, variable number of shares. What they say? $10 million you have given me. As on the date of 31st of March 2022, we will see the price. We will see the price of the share, the market value, and accordingly the number of shares will be given. For instance, if it is on this particular day, say $1,000 is a market value of the share of B company, then how many they will be getting it? 10 million they will be, so they may be getting around say 10,000, or let's take our example as 500. $500. So how many shares they should be getting it? 20,000 shares. Why we are talking about this? Convertible debentures may or will be settled in the own equity shares of the B company. So this is an example for your fifth point. It's a financial instrument. This particular thing is covered by your fifth point. Convertible debentures may or will be settled in the own equity shares of the B company, and it will be given in the variable number of shares. Variable number of shares is basing on the amount, principal amount divided by the market value as on the date of the conversion. Okay, this is clear. So this is how it will be like. And your sixth point, your sixth financial asset is the derivatives. Derivatives, forwards, options, and futures at favorable position. Favorable position. Let's take an example. You have a C in your hand, call option. You bought a call option to buy a Reliance share at 2,400 rupees on 1st of November 2022. On 31st of November, 31st of October 2022, when you are closing your monthly books of accounts, the share value is around 2,500. Meaning, you are in a favorable position, you are on a better side, you are in a better position of 100 rupees. So this 100 rupees is a financial asset as on 31st of October 2022. So this is your sixth point. So to summarize, cash and cash equivalents by default is a financial asset, and equity of another entity by default a financial asset. Contract right to receive the cash or other financial asset is a financial asset. So we have seen the example for the cash, trade receivables, loans extended, etc. And other financial asset is a contract. Instead of they paying the cash, if they are willing to settle under using the other financial asset. And contractual right to exchange a this financial asset or financial liability and in a favorable position, and contractual contract for settlement may or will. Okay, it can happen or it may not be happen. Like they can settle in cash, or they can be settled in shares also, variable number of shares of the own equity share. This is like convertible debentures, which can be settled by the cash or by the debentures, and debentures should be variable number of debentures. Why not the fixed? If it is a fixed, it can be considered as good as an equity, but it's an optional, right? It's an optional convertible debentures, so the other party can be taken it as an equity. Still, it is a financial asset in your hand, but then that will not be covered under point number 5. It can be considered under point number 2 or 4. And point number 6, all the derivative contracts which are in favorable position can be considered for your financial asset. So this is about financial asset. Now let's talk about, so the same points are mentioned over here. Okay, same way you can see all the points, the last 4 points, which are all under the favorable position will be a financial asset to you, to the other party who agreed to pay, who agreed to exchange, who agreed to issue, or who agreed to convert into their own equity shares. okay, who are agreed, who are the writer of the options. So the other party, the counterpart of a company, are, for them all these are the financial liabilities. Okay, so if we quickly see financial asset, you can once again check all these 6 points. Financial liability, contractual obligation to deliver cash. So here we have seen this point, third point. Trade paid other financials to other entity. So if someone need to pay you the cash, it is a liability for them. If someone paying you instead of cash, if someone is paying you financial asset, then it's a liability for them. A contractual obligation to exchange the financial asset or liability unfavorable to the entity. Derivative contracts which are under unfavorable position, as we have seen the, so here in this case the writer of the Reliance share, the writer of your call option will be considered this as a financial liability, that particular 1 rupee. And then the equity instrument, any contract that is having a residual interest. What do you mean by residual interest? After all the left out, for instance, if a company is into liquidation, then the what all the proceeds by selling of the property will be first utilized to pay off all the liabilities. So if there is any residual part left out, and if a person is getting interest, if a person is getting a portion of it only from the residual interest, then we can say that he is holding an equity instrument. Okay, in the assets of the entity after dating all its liabilities. Compound financial instrument. Compound financial instrument is having both financial liability and equity instruments. So what exactly it is? So there are certain instruments that carries the futures of both the financial liability and the equity. We will be seeing certain examples so that you can understand it more better way. So well, let's see, test our understanding. Okay, cash, financial asset. Cash equivalents, financial assets. Bank balance, cash equivalents, financial asset. Deposits given, you have given the deposits, like you have given certain loans, you have invested in some public deposits, so you will be getting back the cash. It's a financial asset. Deposits received, you have received the cash and there is an obligation to you to pay. You have seen in the third point a contractual obligation to, sorry, the contractual obligation to deliver the cash, you have to pay the cash back to them, the depositors, so it's a financial liability. Trade and other payables, so we have to pay the money to them, or maybe we have to pay certain financial asset, then it is considered to be a financial liability. Trade and receivables, financial asset. Bills receivable, financial asset. Bills payable, financial liability. Inventory, inventory as such, it's not a contract to get the money. Maybe after once we make the sale, that transaction will give you, that particular contract of sale will give you the right to receive the money, but not today. So this is an other asset. This is an asset but not a financial asset, this is an asset. Salary payable, it's a liability, you need to pay the cash to an employee, so it will be a financial liability. Loans, including the bank loans, so we have to pay in, deliver in cash, financial liability. Investment in the equity shares, you have invested, so this is already covered under point number 2, financial asset. You have invested in debenture or bond, okay, so you will be getting back the cash, financial asset. Perpetual debt instrument held, perpetual debt instrument in the sense like the debt, the debenture will be perpetually continue, it will not be paid immediately. Okay, we will be seeing this. Still at the end of the day you will be getting the money, right? Fixed asset. Prepaid expenses, prepaid expenses in the sense you have already paid in advance. For what? For goods or maybe for the services. Will you get back this money? No. What maximum you will get? Maybe you will be getting some goods or maybe the balance services, right? So it will not be considered as financial asset, but it can be another asset. Promissory note to receive the government bonds. You will be receiving government bonds, but ultimately these government bonds will give you the cash. So once you get these government bonds itself is a financial asset basically. So receiving a financial asset, the right to, the contractual right to receive a financial asset itself is a financial asset. Promissory note to pay government bonds, financial liability. PPE, the plant property and equipment, this is a fixed asset, this is not a financial asset. Intangible assets, not a financial asset, other assets. Advance given for goods or services, this will entitle you to get the goods or services but not the cash or the financial asset. So this is another asset. Dividend proposed, it's not a liability asset. The dividend proposed will be liability only when it is declared. So till such time this is neither asset nor a liability, this is only a proposition. It can be considered as a contingent liability or something, not even that. So advance received for the goods or services, advance you have received, will you be liable to pay in cash? No, you are liable to pay the goods, you are liable to give back them the goods or the services. So it is not a financial liability, it's another liability. Deferred revenue, okay. You have revenue, you have deferred your revenue, and it's not a, for instance, like you have not considered the whole amount, you will be keeping on your receivable, or one side on the asset side you will be considering a receivable, and the liability side you will be showing the deferred revenue. So it's another liability, it's not a financial liability. Warranty obligations, you will not be paying them in cash, you will be paying, you may be probably you will be doing the repairs for them, right? So it's not a, it's another liabilities. Income taxes, it's a, you will not be getting any cash, okay, as such, or you are already paid the cash. So it is basically income taxes here means like advanced income tax, advanced taxes which is already paid. Financial guarantee received, it's a guarantee received. So these guarantees are just like a contingent assets or liabilities, guarantees issued or taken. So if you have received any guarantee, it does not mean that you need to make any payment unless you make any event that will prompt to make this guarantee executed, right? So till such time it is not considered to be, this is not even a other liability as such, it will not be it will be only form part of your notes to accounts, okay, notes to accounts. Mandatory redeemable preference shares, so it's mandatory to redeem the preferable shares, it can be considered financial liability. Right to use the assets, as such, it will not make you to pay any cash or anything, right? It's only your right to use, so it is only another asset. Financial guarantee given, it's not a liability, it's not even a liability, only in the notes to accounts you have to show. You bought a gold as such, no, it's not a financial asset, it's an other asset. Gold bonds held, because the gold bonds, the moment you give back the gold bonds, there is a right, is a contractual obligation on the party whoever have issued these gold bonds to pay you the cash, right? So it's a financial asset in this case. So there is no contractual obligation, you just bought the gold and you are holding it, so there is no other party who has a contractual obligation to pay you back any cash or any financial asset, right? So this is just another asset. While in this case, the moment they issued a bond to you, it is an agreement stating that once after the maturity period, I'll pay you back the money. So this is a financial asset. Dividend declared. So you have already declared the dividend. Dividend declared. Once declaration being done, it can be considered to be a financial liability because one has to settle it with the cash. Credit balance of the debtors. The credit balance of the debtors means that you have received the goods, you have received the money in advance, right? So you are showing it as, but does not mean you need to provide them only the goods or services. So it need not be considered to be a financial liability. It's an other liability. In fact, how we will be doing it, we will be netting off in the debtors. Advance tax, you have already paid it, it's another asset. Loans extended, it's a financial asset. Lease receivable from the lessor, so it is a financial lease receivable. Yes, it's a cash, you are ultimately receivable as some cash, like trade receivables. Security deposit given is a refundable security deposit. You will not get the services for this, or you will not get the goods for this. It's just a caution deposit you have given, so you have to get it back. So it's a financial asset. Investment property, other asset. Share warrants. In the share warrants, the moment you have a share warrant and you produce it to the company, you have to get back a equity instrument, right? Equity instrument of the other company. Equity instrument is nothing but the financial instrument. financial asset. So it is also a financial asset. Instrument that can be convertible into variable number of equity shares, instruments that can be convertible into fixed number of equity shares, which we have seen before. If it is convertible into variable number of equity shares, it is a fixed financial asset. Instruments that can be convertible, basically this is from a point of view of the issuer. Okay, so let me also talk it in this way. If an issuer has to give fixed number of equity shares, it is an equity for them. Instruments that can be convertible into variable number of equity shares for the time being can be considered as a financial liability. Security deposit. So these 2 points we will be seeing once again. Anyways, we have in-depth discussion for the equity, preference shares, and the bonds and debentures. So we'll be seeing once again. So don't worry about that. The same point is getting discussed over here. You can see compulsory convertible bonds, variable number of shares. So I'll be discussing here in detail. For the time being, you can consider this as a financial liability, or I'll also talk about compound financial instrument. The security deposit accepted. You have received the security deposit, so you have to pay it back. You can't discharge it or settle it by the goods or services. So it's a financial liability. Capital work in progress is other asset. Provision for the income tax is another liability. Clear? So after we gone through these various scenarios, let us focus more onto the equity, preference share capital, and bonds and debentures. But when you are looking at it, keep as if you are the issuer. So we are talking from an issuer point of view. Okay. So in the balance sheet of the issuer, this equity, this preference shares, and the bonds, the issuer point of view. Okay, not the holder point of view. Now, equity is now divided into equity is for equity share capital, reserve surplus, and other equity. Other equity, be it like general reserves and all other equity part. So equity share capital we have subdivided into puttable equity shares and non-puttable equity shares. Puttable we have already discussed it, like or we'll be more discussing in the further coming up in the same session. So puttable equity shares are those where you can just go back to the company and give it, and you can get back the funds. The bondholder give it back to the company and get back his funds. So that is a puttable. So there is a put option that which is more beneficial to the bondholder. So in case of puttable equity shares, if issued by the company, and there are certain conditions involved, more or like the puttable bond option holder, they cannot get the money. So basically they'll keep getting back other kind of rights, or if he is getting only the money at the time of liquidation, there are certain restrictions on the provision of put. Okay, in that case, if those conditions are fulfilled, then it can be considered as a equity instrument. EI stands for equity instruments, FL stands for finance liability, FA stands for financial asset. Okay, so in that case it can be considered as a equity instrument if those conditions are not fulfilled, meaning if the puttable equity share, just like that, puttable equity shareholder can come to the company, give back the equity share and get his money back. In that case, it is just nothing but a financial liability, because it is not a residual interest. It is no more a residual interest. It is at the option of the bondholder. He can get back his money anytime. So it cannot be no more an equity instrument. Even though you call it as a puttable equity instrument, it's not an equity instrument for the purpose of IFRS. Okay. Non-puttable equity shares, any equity share, even callable equity share or a convertible equity share, no such convertible equity share, callable equity share, or any other regular or plain vanilla equity share. So all these are non-puttable equity shares, and those are an equity instrument with no doubt. All reserve surplus equity instruments and other equity are equity instruments. Why we need to see whether it is an equity instrument or if it is a financial liability or it is a financial asset? Because IFRS deals with each one differently. Once you classify it as an equity instrument, its recognition, its classification, its measurements, subsequent measurements, derecognition and all is different when you classify it as a financial liability. So if there is a puttable equity share, even though it is an equity share by name, It is considered to be financial liability for the purpose of IFRS, and the treatment should be as per the financial liability and not as per the equity instrument. So that is the essence of this classification. Okay. Now, okay, let me these things so confusing. Okay. Then preference shares. Again, preference shares we have classified into many, whether it's a redeemable preference share or it's an irredeemable preference share. Okay, and also whether it has an ability to compulsorily convertible or optional to convertible. Participating redeemable preference shares. Participating in the sense they can participate in the profits, they can participate in the voting rights and few participating rights. Generally only equity shareholders does have the voting rights, does have the participating in the profit rights. But if a preference shareholder does also have this if there is any additional clause or additional provision, so in such case how it need to be classified. Okay, so let us start with the redeemable preference share. So the meaning, so this preference share will not be wait till the liquidation, maybe it has some periodicity, say 10 years or 5 years later this particular preference share had to be redeemed, it has to be paid back to the holder. And cumulative preference shares versus non-cumulative. Cumulative meaning, for example, if one particular year 1, if company does not have the profits, but then they have agreed to pay 6% preference shares, then they have to pay 6% in an year. For example, in year 3 they got the profits, so year 1 plus year 2 plus year 3, so they have to pay $18 in year number 3 whenever they got the funds and whenever they have some money to pay the company. So cumulative, this interest will keep adding till company makes the payment. When it comes to the non-cumulative, if company does not have the money in year number 1, so the holder is as good as he lost the money. So company no need to pay it, no need to accumulate it. If they have money only in year 3, if they have profits in only year 3, the company can pay only for year number 3 only $6. 6% interest can be paid only for that year. They don't need to pay for the previous periods. So that is non-cumulative. Okay. Now if you see redeemable, so the bondholder, the preference shareholder will get back his money, so it's just like a liability. And also if he is getting all his interest, all his cumulative interest like from the beginning, so this is, then there is a contractual obligation to pay. If there is a contractual obligation, then it's simply nothing but a financial liability. Even though you call it as a preference share, it is not a share like a capital, it is just like your financial liability. But if there is no contractual obligation, if their company can skip, even though it is they need to pay $18 in year number 3, but still if they can, by virtue of the contract, there is no obligation of the company to pay, then it is a compound financial instrument, which I was telling before. It has both the features. Number one, future of financial liability because it is redeemable, it is payable, right? In case of equity, there is nothing, no redemption. It is only at the time of liquidation the payment should be done. However, in this case, financial liability redemption, like a financial liability, like an equity, no need to pay the interest, no need to pay interest. It's at a discretionary, there is no obligation, it is at the discretionary of the company. So it's a compound it has both the features. Same is the case non-cumulative preference shares. So the accumulation will not happen for the interest. It has both, it's a redeemable plus non-cumulative, so it is a compound financial instrument. However, redeemable plus fixed dividend, they have to pay, there is a fixation of the dividend they have to pay, then it is a pure financial liability. Similarly, irredeemable preference shares, so this is like a financial liability, right? The future is like a financial liability. Irredeemable, there the company need not require to pay till the liquidation time, so this is more like an equity. So if there is any other equity feature plus equity feature, then it will give you equity instrument. If there is an equity feature plus financial liability feature, then it is something like a compound financial instrument. Now let us see irredeemable plus cumulative preference shares. So irredeemable, equity feature, cumulative, so it will keep adding. So more of this is also a financial liability, this is also like a financial liability feature. But then if there is a contractual obligation, it's a compound. If there is no contractual obligation, even though it is financial liability type, but since there is no, it's a discretion of the company, it will become a pure equity instrument. Here, equity instrument, it's a non-cumulative, no need to pay, it's at the discretion of the company, and also only at the time of liquidation it's required to pay, so it's a equity instrument. Now, compulsory convertible, and the obligation, whether there is an obligation, compulsory convertible preference share, so for sure it is going to be an equity instrument, so we can call it as an equity instrument. But then if there is no obligation to fix it, if there is a contractual obligation to pay the fixed dividend, then it's a compound. If, because this is a feature of the financial liability, because your interest you are bound to pay, so it has both the features of equity plus this is a financial liability feature. This is equity feature and this is an equity feature, so it's an equity instrument. Participating redeemable preference shares, so they can participate in the equity rights and all, which we have seen. So since they can participate, it's a compound financial instrument. This is like a participating because they can participate in the profit, so equity type of feature. But then redeemable, it's a redeemable, so it's like a financial liability feature, so it's a compound financial instrument. Then bonds and debentures. Bonds and debentures are issued, it is redeemable and irredeemable. In India there is no concept of irredeemability, but overall if there is a redeemability, it is like a financial liability feature. Fixed interest, discretionary is like a equity feature, so it's at the option of the company, at the time of liquidation they can pay, otherwise they don't need to pay. So it's a combination of financial liability feature plus equity feature, so it's a compound financial. It's a fixed interest, it's a financial liability feature plus financial liability feature. Irredeemable, it is more of equity style of feature, right? So no need of making the payment. So this is fixed interest, but then fixed interest, so it's a financial liability feature, so that's why it is a compound financial instrument. Irredeemable feature, it is more of equity style plus discretionary, both are equity, so it's straight equity. Convertible debentures, optionally convertible into equity, so you can straight call it as equity, but then it is optional, we don't know whether it's going to convert or not, so it has both the options, whether it can be discharged in the, it will be settled in the cash, or it will be settled in the equity, so that's why it's a compound financial instrument. Compulsory, there is no other option, compulsorily convertible. But then still, if it is a variable number of shares, if you remember, there is a point here we have seen, a contract that will be maybe settled in many owns in an entity's own equity instrument is non-derivative, for which obligated to deliver a variable number of equity entities own equity instrument. In that case, it is a financial liability. So that is the case what we are talking here. Variable number of shares is financial liability. If it is a fixed number of shares, it is an equity instrument. Okay. And zero coupon bonds. Zero coupon bonds is something like which will be issued at the beginning of the at the issue time, and the payment, any payment including interest over interest, everything will be paid on the maturity date. And there will be it's a redeemable one, so obviously it is a financial liability. There is no equity feature at all in ZCB, zero coupon bond. We will talk about zero coupon bonds little later. So that's all about for the accounting, starting with the basics. Tomorrow we will be in the next section, we will be seeing this what we call that recognition, the initial recognition, and measurements, how we need to be tackled. Okay, let's move on to the valuation. Thank you. Let's work on these things. And now we'll be seeing on the financial instruments, what are the fixed income securities, the things that are relatable to the fixed income securities are what we are going to see now. The fixed income security, or if you call it as debenture, debt securities, or if you call it as bonds, whatever the name nomenclature you use, it's the same ultimately. The issuer. Who can be the issuer? Issuer can be a corporate, a company can issue it, or even a government. A central government can issue, or maybe a state level governments can issue, or even quasi government. Quasi government in the sense like postal offices and all. Supranational organization, supranational organizations can also issue something like a World Banks. World Banks can also issue the bonds. So we can subscribe even to the World Bank's fixed income securities. Special legal entities or special purpose vehicles. We will be seeing it little later. There are certain special purpose vehicles will be floated exclusively for issuing of the fixed incomes and securities, which we will be seeing it later, how actually the structure of asset-backed securities will work, mortgage-backed securities, and CDS. So these things we can see it in the later sessions. For now, we will be going with the basics only. Maturity. So how many years later the principal will be paid to the subscriber? So it is like you can see a subscriber, an issuer. The issuer will be issuing to the subscriber of the fixed income security the bond. He will be getting a bond, right? He'll be getting a bond. So he will make a payment to the issuer, say $100 or $90. He'll be paying at the end of the period, at end of the year, like say like 5 years or 3 years or 1 year, whatever the time period. Then he'll make the payment. Repayment will be paid to him at the par value, at the face value, whatever he agreed on, the issuer. So basing on the maturity, the classification of the fixed income securities will happen. What I mean by that? Maturity is the date by when the issuer will pay back the money to the subscriber, right? The tenor is a balance period. For example, there is a 5 year debenture have been issued and 2 years already lapsed. So the balance tenor is 3 years. Money market instruments, money market securities is anything whose original maturity, the maturity period whose original maturity is less than 12 months, less than or equal to 1 year, then we call it as money market security, something like commercial papers. Capital market securities are those whose maturity period is more than 1 year. Okay. Par or principal amount. Um, okay. The par or the principal amount. So at what rate? The principal amount, the principal value, simply principal of the bond is the amount that the issuer agrees to repay to the bondholders on maturity date. So the amount of, so this in our example, so this is what this $100 is what the par value, the amount at which the issuer will be repaying it back to the bondholder or the subscriber. It has a very different names like a par value, simply par face value, nominal value, redemption value, maturity value, whatever the name you call it, ultimately the same meaning it has. The coupon rate. Coupon rate is the interest rate at which the bondholder will be getting it from the issuer. So it's like the interest rate is a contractually agreed interest rate which bondholder will be getting as a contract from the as an obligation of the right from the issuer. Frequency, how often this interest will be paid. So the bondholder can get yearly once the interest, or he can get twice in a year, or quarterly, like 4 times in a year, or even he can get monthly, like 12 times in a year. So there's a frequency: annual, semi-annually, quarterly, or monthly. He'll be getting it. Fixed rate bonds versus float rate bonds. So there are there are certain bonds which are issued, the majority of the bonds are issued with the fixed rates. So 6% debentures, meaning like 6% interest per annum will be paid. However, there is also floating rate bonds, which in other words called as floaters. So here what they will do, they will be linking it to some market reference rate plus some spread. For example, market reference rate could be any repo rate or LIBOR or LIBOR, IBOR, Europe interbank, Hong Kong interbank offer rate, or Singapore interbank offer rate. So whatever the LIBOR plus maybe 25 bips, 25 bips or whatsoever. So for your understanding, for every 1% is 100 bips, meaning every 0.1% is 0.01%. So every 1%, 1% is like 1 rupee. 1 bip is something like a 1 paise in Indian terms. Or if you 1% is something like, if you call it 1% as $1, then 1 bip is something like 1 cent in dollar terms. Okay. Zero coupon bonds is when there will be no interest will be paid until and unless the maturity. So all the interest which, there are two type of bonds. The bonds in which you will get the periodical interest, maybe quarterly, annually, semi-annually, or whatever it is. There is a other set of bonds which are zero coupon bonds where the interest will be paid only on maturity. So you will be paying say $80 now. you'll get $100 at the end of the maturity, maybe say 3 years or 5 years. So in between, you'll not be getting any kind of interest. So that's a zero coupon bonds. There is another term also called deep discount bonds because it's a deep discounted. In other cases, you will get the interest, while in this case, you will not get the interest. So these bonds will be sold at very deep discount. This discount covers your interest. And then the currency, you can buy in your own home currency or single currency bonds, or you can go for a foreign forex convertible FCCBs, foreign currency convertible bonds. There are some foreign bonds that offer you. So this is like a bonds issued in local currency. So you are from India and you also subscribe to a bond that is from Indian company. So you have bought it in your local currency and all your proceeds, be it your interest, be it your principal, you will be getting it in local currency only. But if you have subscribed to a foreign bonds, then there are two type of bonds you have to see. It's a dual currency bonds and currency option bonds. While in dual currency bonds, you can ask your issuer. If you are a bond holder, you can ask your issuer of the, I mean, the company which has issued the bonds, can you interest you can ask for in dollar terms, and your principal you can ask in rupee terms. Okay, that's called the dual currency bonds. Whereas currency option bonds, you can ask interest, each interest, one month of interest you can ask in dollars, another month of interest you can ask for in rupee, and principal also you can either ask in dollars or you can ask for in rupees. So you will be getting more flexibility. So that will cover a lot of your forex fluctuations. That will help you to come out of that currency risk. Okay, bonds issued at par, discount, and premium. If your par value or face value is $100, so it meaning at the end of your maturity date, the principal amount paid by the bond holders to the bond issuer to the bond holder is the par value or face value. Say for example $100, and if this particular bond holder is buying it at less than $100, anything less than $100, we can say the bonds issued, or if the bond is issued itself is at say like a $90 or $80, we can say it has issued at discount, or it has issued at premium in case if the amount subscription amount is more than the face value, and it will be called as at par if the bond is issued, or if the bond is getting the market value, the current market value of the bond is exactly equal to the face value, then it is called as par. Okay, then straight bond, we have seen all these the bonds so far. We have seen more or less there are the straight bonds, meaning they don't have any options in it. So it's a straight bonds with options. It's a plain straight bond you can call, or most commonly it is called as a plain vanilla bond with no embedded options. While there are certain other bonds with options like callable bonds, puttable bonds, convertible bonds, we will be seeing it in little now. Yeah, in the next point onwards, we will be seeing what exactly is this. See, callable bond. Let us take an example. You, Mr. X, has subscribed to a bond from A company, A Limited. Okay, this was subscribed on 1/1/2021. What A Limited told, see, I'm paying you 6% interest. I have agreed 6% debentures. Right? While issuing this, they have a call they with a provision called callable provision. Callable provision, meaning A Limited, maybe if they have any favorable terms in the market. See, there is a bank, they came up to A Limited saying we can extend a loan with 5% only. Or another case, the market rates itself have fallen down to 4%. Or A Limited credit rating has went up, so credit rating. So if it issues a new bonds now, if it issues a new bond, people are ready to subscribe for 3% only. So in these cases, what A Limited will do, there is no meaning in paying at 6%. Now, after fall in the prices of fall in the rate, the interest rates, and bank is also willing to extend a loan less than the current rate of interest, then A Limited, it will try to take an advantage of it. But for it to take an advantage of it, it should add a callable provision. Otherwise, it has to wait till the maturity period. So what they will be doing in the callable provision, they will be simply go back to X Limited, Mr. X, and say, yeah, I'll be paying back your money. Just take it and give me back my debenture. Okay, so this will be done. This is more favorable to the company, and when they will be doing, when they have a favorable situation in the market. And there are three type of callable provisions. The three type of provisions are available, like American style call, meaning, for example, first of 2021 they have issued, and it is for 10 years, say 31st of 12 2031 or 2031. Okay, during this period, if you can go, sometimes referred to as a continuously callable. Okay, so if during this period, entire period, anytime A Limited can come and call back its bond, then it is called, then it is just like an American style of call. While European style of call, they will specify a specific date, like see, uh, 31st of March 2025. So on this particular date, they will check if the market rates are low or if they have any favorable position. And if it is so, then only on this particular date they will call for the bond. Though this is European style of call. Bermuda style of call, they will give a specific, so they will mention like 5 years non-callable period. 5 years means like 31st of 12 2026. So during this period they will not call for anything. They will not call for anything during this period. 25, okay, 21, 22, 23, 24, okay, 25. So during this period, they will not be calling for anything. Later, they will be specifically giving some certain days, say for example, 30th of June 2026, 31st of December 2026. Similarly, like they will be giving certain dates. On these respective days, any date they can choose for calling it back. So this style is called Bermuda style call. American style, any date, anytime. European call, only once, only one particular date they will be giving. Bermuda call, they will give a specific period which they will not be calling, but then after that they will be giving certain dates, like every 6 months or every 1 year they will be keeping certain dates. So on any particular date they can call for it. So they will be keep checking it, the market rates. So this is all about callable bonds. Exactly opposite position is a puttable bonds. So puttable bonds, your Mr. X has subscribed from the A Limited. Now, if Mr. X is getting 6% earlier, now market rates have been improved better. So people are getting 9% for new bonds, or maybe if they are getting for FD rates, or now 9%. So what he will try to, he don't want to keep his money with A Limited. He want to get back his money and then invest in the new FDs, right? In that case, he should be having a new, he should have in his hand a puttable option to sell back the bond to the A Limited. He can get back his proceeds. So this is a puttable option. So that's exactly like callable option will be favoring to the company, puttable option will be favorable to the subscriber. So if normal bond, plain vanilla bond is 100 rupees, a callable bond will be which is favoring to the company. So generally people will not be interested to buy. So they will be buying only if it is less than the face value or less than the par value, right? Less than the plain vanilla bond. Similarly, a puttable bond is the thing that is more favorable to the customers for the subscriber. So they are okay to pay even a single 1 rupee or 2 rupees more premium to get something more in their hand. Like they can give it back to the company as and when they want. So here maybe they will be paying $1 or $2 or $1 or $3, slightly more than the plain vanilla bond. So I have given more details about this. You can just have a look at it. Same is the case, European style. European style bond can be on a very specific day. The bond holder can go back to the company and sell off his bond. And Bermuda style, there will be certain clause, there will be certain period, lock-in period, and post to that there will be certain specific dates on which dates the bond holder can go back to the company and he can give it back to the company and get back his proceeds. Convertible bonds. Convertible bonds is a hybrid of both equity and okay, we'll be seeing it more detail. But then convertible bond is where you will be having a bond. For example, 6% bond you bought for 10 years, okay, and with an option to convert, maybe say 5 years later, and you have invested $10 million, which you have already seen. $10 million was invested. So company has given an option to the bondholder to either hold it as it is, or you can convert it to the this particular equity. Okay, and there are two types. There one thing is 100% compulsory convertible bonds, and the other one is optional convertible bonds. So basing on the option, or if it is 100% convertible bonds, your classification of the financial instruments will go for a change. We have seen it already. Then now, what is this? So the terms that are important for the convertible bonds are conversion price. See, bond you bought it $100. Okay, equity price that time, for example, 1/1/2021. So 1/1/2021, the equity is at that time maybe say $20. Okay, so basing on this, on 1st of January 2021, company says so your conversion price is $20, meaning after 5 years or after 6 years, whatever the time that was given later, whatever the equity price is that time on 1/1/2026, for example, the equity price is say $50. So irrespective of this, you will be getting at a $20 price. So you will be getting sure 5 shares for every one bond. So 1:5. For every one bond, you'll get the 5 equity shares. Okay. This is called as a conversion price, and this ratio, the same thing. If you are putting in a ratio style, it is called as conversion ratio. Conversion value. Okay. In the same example, what is the conversion value? So you are getting 5 shares into now the current market rate is 50. So 50 around 250. $250 is the conversion value. Okay. The value what you are getting after the conversion is called your conversion value. Conversion premium. So conversion premium is nothing but your $250 minus how much you have paid, $100. So $150 is your conversion premium. Similarly, conversion parity, if you want to check that whether it's a parity, one side you have paid $100, and the other side you are getting a benefit of $250. So this is not in parity, right? This is not in parity. Then what is parity? If you are also getting, when your conversion price is to conversion value is the same, if conversion price and conversion value is the same, then you can say both are in parity. Okay, now let us see what is. If your conversion price is more than conversion value, meaning conversion price means like bond, for the amount that you have paid for the bond and the value of equity that you have got today. Okay, now if you have paid, then you can call it as a below the parity. If both are equal, then you can call at parity. If equity, if you got more benefit, in our example we got more benefit, like $250 worth of benefit we got when we have paid only $100, right? So this is called above the parity. So there will be one example which we'll be seeing on this point. Clear? Okay, so we have seen conversion premium is done, conversion parity, warrant. Share warrant is something like a right. You will be getting a share warrant. You can just carry the share warrant. go and submit it to your respective company, the company whoever have issued the share warrants, and it is transferable from one person to the other person. So that the person who is holding finally the share warrant will get a shares, the equity shares from the company. Okay, so that's a share warrant. Contingent convertible bonds, COCOs. Okay, this is slightly interesting. Now, convertible debenture you have in hand. Okay, you paid $100 for it, and if you convert, for every one bond you will be getting 5 shares. Okay, what you will get like equity shares. Equity share value today, the share price today, today's equity. I mean, on the date of conversion. Date of conversion, the share price is around 50. Same example, $50. So you will be getting a value of $250. So will you execute? Will you jump and convert your bond into equity share? Yes, you will be doing it because for $100 you are getting $250 of benefit. But what if it is going instead of $50, it is only $10. So the benefit is you will be getting only $50. So you will not be doing it, right? But for the favor of the companies, so they have something called COCOs, like contingent convertible bonds. In these cases, if this is so happened, then company has an obligation, company has a right to convert, whether you like, whether bondholder likes it or dislikes it. In these cases, they have every right to convert, and you convert, your bond will be converted into equity so that they don't need to pay the amount immediately, and also the amount of discharge what they are getting is very less. So generally these will be sold at very deep discounts. Okay. This happens when this is just to protect their credit risk. For example, if their credit rating is fallen and if their equity has fallen down, so obviously they will be choosing it to convert your bond to a lesser priced equity share. So COCOs are just like opposite to your convertible bond is in your favor, and COCOs, contingent convertible bonds, are in the favor of the companies. Okay. Yield measures. Okay. Before that, before we talk about yield measures, and this is a very long topic. For today, I am restricting it to the most basic topics, but still it is very valuable. Don't miss it. And the a bond, why you buy a bond? It's a very purpose is to earn some income, right? And it does not mean only the interest income. Bond will not just give you only the interest income. It has a capability of giving you the capital appreciation also, right? Just like an equity. What are the situations of it? We'll be seeing it now. Capital appreciation. When this capital appreciation can happen. So if you see the capital appreciation possibilities, one, even though if okay, let me tell you the credit rating. If there is a credit rating, or let me start with a basic example. You bought a bond at 6%, okay, and in the market, FD rates or whatever the rates, whatever the interest rates people are getting is fallen down to 4%, and your bond is for 10 years already. The tenor, the balance period is around 8 years. Okay, that is the maturity period. The total period of the bond 10 years, and the tenor, the balance period is 8 years. So for the next 8 years, you are going to earn 6%, while the same people, the other people, if they want to invest in other FDs, they'll get only 4%. So your bond has got up, it is going to give 2% per annum into 8 years. Even if you present value, if you convert it down to current present value, say like 12 rupees or $12, you are going to get more than your peers. Okay, if you want to invest today compared to what you have done 2 years before, is going to give you $12 more. So obviously, if someone is buying 100, your bond value is now brought up to $112. So the bond value is now $112, isn't it? So this is what the one style of conversion, the capital appreciation what you are going to get. Now let us see it. The coupon income, the current yield, We'll be seeing the formula for it. Here it is. And the roll down return is okay. Roll down return also this constant yield price trajectory. I'll be showing you this in Excel. So for your ease of understanding, for investors, change in the benchmark yield, the which we are talking about now. Your bond is carrying 6% while the interest rate in the market is only 4%. So your bond value has been increased now. So that's what this is talking about. And this the change in the price due to the investors yield spreads. Yield spreads is nothing but the credit spreads. Okay, now this 6%. Why you are getting 6%? Inflation, say inflation 3%. If a bond you are getting 6%, meaning you are not just getting for the inflation, right? Inflation is for the 3%, and say 1% is for the kind of you are losing your opportunity cost for the time being, and then 2% is for the credit risk what you are taking. There are various levels, you can see it, which I'll try to explain in the later sessions. So you are taking a credit. Your 1% is the risk-free interest, you can call it. 3% is the inflation. Government bonds are anyways paying 4%, so they are already paying your inflation plus the risk-free interest rate, and you are getting 2% more for the credit, because instead of you investing in a government bonds, you are investing in a corporate bonds, and you are taking a chance, because these corporates may or may not be in a position after 10 years. We don't know if the corporate can still continue or if they lose its existence. So for this reason, this 2% you are getting more when compared to a corporate bond. Okay, say for example, you are getting it like this, and then what has happened later? After 3 years, the corporate is doing so good. The corporate rating has went up so well. Now the corporate is started paying only 1% for credit spread. Earlier they were paying 2% for the risk of the bondholders. Now the credit rating, the operations of the company is now so flourished, so it is not paying 2%. Now it is only paying 1% of credit spread. So obviously your rate, you are getting 6% while others are getting only 5% now. So your bond price will go up. Okay, so this is one way of getting your capital appreciation. Same as the currency value. You have invested in the dollars at 70 rupees per dollar. Now it is like 85 rupees per dollar, or 83 or 85 rupees per dollar. So without investing anything more, already 15 rupees per dollar have been increased. So there is a capital appreciation from the currency value. So these are the possibilities of the incomes for a bond, not just only the interest income. So these are the five other incomes. We'll be seeing one by one, and hopefully for today we will be able to see the points like this roll down return and a little portion from this one. Okay, current yield or running yield, another name, is nothing but your the bond price. What are the bond price that you bought? The market, the current market price, not the face value. Okay, not the one that you will be getting it later. So it is just like the coupon rate. For instance, 6% debenture is now selling in the market for. We have the same example. 6% debenture, $1,000 is a face value. Now it is selling at $10 more. So it is not just only 0.6%. This is 5 point, not just only 0.6%, 5.94%. 6% is the coupon rate, contractual obligation of the bond issuer to pay to the bondholder. But bondholder has bought it for $1,010. So though he is getting 6 rupees or $6 from to his pocket, $60 to his pocket, he slightly paid more, not just only $1,000, he slightly paid more. So what he's actually getting is 5.94%. So that is the current yield. Yield to maturity, yield to maturity, we will also see something called spot rates, forward rates, par rates. Okay, we'll be seeing in the tomorrow, like the second session, we'll be covering all those points. Okay, and then what is a YTM? Like on 1st of 2021 you have invested, and this is having a maturity till 31st of 12 2025. So 5 years of period. Okay. First year, second year, third year, fourth year, and fifth year. You have issued 6%, $100, 6% debenture. You have subscribed to 6% debentures. Face value is $100. So you will be, there is a minus. So today you will be paying. Assume that it is issued at par. You bought it at par. Then you will be started getting 6 plus 6 plus 6 plus 6 plus 6, and also your principal amount. Okay. If you could, if you could invest this 6 also at 6%, okay, then what it will be? It will be giving you the next year. You have invested this till this period. Okay, then what you will be getting it? 0.36, 0.36, 0.36, and you will be getting here 0.36 plus your $6. Similarly, in this period, you have invested not only this one, like you got the moment you got it, you immediately invested 6%. You have invested both 6.36%. So on this day, you have in hand how much? $6.36. You have the $6 from this one, this particular investment, and $0.36 is from the investment of the minus six, this the 6 interest what you have gained. So if you could invest this 6.36 also at 6%, then you will be getting how much there? Say for example, zero point 0.4, say zero point 0.4 as an example, zero point 0.4, zero point 0.4. You will get your 6.36 and zero point 0.4, right? Same way, in this period, you have 6.76 in hand in total, 6 plus 3.36 plus zero point 0.4, altogether 6.76. You have invested 6%. So in this way, if you reinvest your interest also, okay, if you reinvest your interest, and if you could get everything, your principal and your interest and interest on interest, everything on your maturity rate, what is the IRR? Meaning you have invested 100 and you started getting something in the some interest during these periods, and you again reinvested and you have earned interest on interest during these periods. Okay, you keep on reinvesting it and you enjoying the complete proceeds on the maturity date. Say you have invested it on 1st of January 21 and you got all your funds on 25. So for 5 years you have not touched even a single dollar. Everything you have keep reinvesting it, and you got something like $125. So the IRR between this is your YTM, yield till maturity. Okay, yield till maturity. So till maturity, you have not taken, you have not enjoyed any single dirham or single dollar or single rupee. You keep on reinvesting at one particular price. This rate, this is called your YTM. And the assumption is all whatever I'm talking about at 6%, at 6%, at 6%. So these are all the YTM rates. So this is the assumption and this is a concept. So for whom it is more useful? Now tell me, YTM. I'm a person, for example, a retired person is there. He got $5 million of pension and he invested in bonds, and every month he is taking some, say this is like 10%. So how much he must be getting it? 5 million, so 500,000. So for each month, like around 40 or 42,000, $42,000 he's taking every month after month, and he's not reinvesting. Again, a retired person has invested $5 million in bonds and he's taking the monthly dividend, monthly interest, and he's not reinvesting. So in this case, YTM has nothing to do. YTM's the basic assumption is you have to keep reinvesting at the YTM rate. Okay. Otherwise, what rate should I use? So see, if YTM is not useful, what should I be using? Par rate. We will be seeing it tomorrow. Spot rates, par rates, forward rates, all we will be seeing it tomorrow. Okay. So that's the concept of the YTM. Constant yield price trajectory. Pull to par. I'll show it through in the Excel. I'll be showing you how exactly it happens. Okay. Then we could able to cover a large amount of theory. Then let's quickly see our understanding is where we are up to for our understanding. An example for the sovereign bonds. Sovereign bonds issued by the government bonds. So the World Bank is supranational bonds. City of New York bond is called as what we call it, sovereign bonds and non-sovereign bonds. And this is called sovereign bonds. So this is answer. The risk of loss resulting from the issuer failing to make full and timely payment. So if the issuer is not paying you on time, then it is like credit risk. Systematic risk, we can see it later if time permits. Interest rate risk is the change. We have seen the example, right? 6% interest is your bonds. What if market goes to 8%? If market goes to 4%? If market goes to 8%, people outside are getting more than your bond, so obviously your bond price will fall down. If market prices are now 4% only and you are already getting 6%, so your value of getting income is more, so your bond price will be going up. Okay, that is called as interest rate. So change in the interest rate, in the market interest rates compared to your bond interest rate is called this. So these answers. A money market security most likely matures in money market security anything less than 1 year. 1 year are equal. So this answer. If bond's price is higher than its par value, the bond is trading at, if bond's price more than par, equal to par, less than par. Par means face value. Face value. Face value. So if the market price is now more than, then you can say the bond is selling at premium. The bond is selling at par. The If it is less than, we can say that bond is trading at discount. So in this case, it's higher than the price value. So in this case, so it is at premium. A bond has a par value of £100 and a coupon rate of 5%. Coupon payments are made semi-annually. So semi-annually 5% into 100. So this is per annum. If it is semi-annually, for every 6 months, you will be getting 2.5. So this is on. Pay twice a year. The coupon rate of a floating rate note. So we have seen it. The fixed rate will be having 6%, 5%, a fixed interest component. It will carry a fixed interest coupon rate. While with the floating rates, they will be added to some reference rates, LIBOR plus some spread, or IBOR plus some spread. Okay. So in this case, the coupon rate of the floating rate that makes payment in June and December. So in June and December, they will make the payments. Expressed in MRR. What are the MRR? Market reference rate. MRR stands for market reference rate plus 25 bips. So I told you what is a bip. Bip is like 0.01% is 1 bip. Okay, basis point. Bips means basis points. Assuming that is 6 month, MRR is 3% at June. So in the month of June, when they were doing it, the MRR is 3% plus they should be getting 25 bips. On 31st of December, the MRR rate is 3.5% plus 25 bips. Now the company is paying it for the, on 31st of December, they are making the payment of interest they are making. Okay, tell me, in December, for which period they will be paying? They will be paying from the 1st of July, isn't it? For the 1st of July till 31st of December. For this period, they will be discharging the interest in the month of December. So, what is the rate that is prevailing on this particular period will be the applicable rate. Not that what is happening in the future, but what is happening during this particular period. So, 3% plus 25 pips. So, which means 3.25% will be the answer. The type of bond that allows the bondholders to choose a currency in which they receive each interest payment and principal. Interest and principal. If they want in rupees and this they want in dollars, then you can say it as dual currency. But each interest, interest one, interest two, interest three, and principal. So every interest, if they can choose dollar, this is yen, this is pound. If they can choose like this, that's called a currency option bond. I don't mean to say like they can choose what are the currency they want. They'll be giving a list of currencies in which they can choose. Most probably like the home currency and the issuer's country's currency. Okay. So assume a hypothetical, and this is about the callable option. Call protection period. So what is the call protection period? You have issued the bond on 21, and that is maturing in 20. Say for example, let's say the same thing. 2028. So this is a period of say like 8 years, right? Okay. So 8 years bond. You told the company is saying first 3 years, I will not call. I will not call, but after 3 years, in the next 5 years, I will call on respect to specific dates. Say for example, 30th of June, 25. They have given certain specific dates. This is called as Bermuda call, right? Bermuda style call option. And this particular 3 years, this 3 years is called as call protection period. So during this period, company cannot call for the bond. Now come back to our example, this particular example. On 15th of August 19, they have issued a bond at 98.195 and 98 at par. So it will be in percentage terms. The face value is $1,000. Be careful, $1,000. 15th August 2029 at 100%, they will be the face value. The face value will be redeemed at 100%, while this is the issue value, okay, issue price. So they have given it a discount, issued at discount. The call protection period. Uh, okay, no, this is not till 2029. This is till 2039, I guess, or thereafter. Okay. So the call protection period. So the issue date till the year in which the call price is happening, hold in part from only 2030. So first 10 years, 2019 till 2029, first 10 years, they can't go for any call for. So the call protection period is 10 years. The call premium. The call premium 2033. So in 2033, they want to pay 102.322%. So what's your face value? Your face value into $1,000. So it will be like $1,023.22 they will be paying. So what is the premium? What's the actual face value? If they want to pay in 2039, they will be paying only 1,000. But now they are paying 1,023. So the premium that they are paying is 23.22. Okay. Don't get confused with this. 2.32% is a percent, not dollar terms. Dollar terms is 23.22. That's why I have told you be careful when you are considering the face value. The call provision is most likely you have a, a particular period, a call protection period, plus you have different dates, right? Every year, every year they can do the call for. So different rates, different dates they have given. So it is a Bermuda call. Which of the following is not an example of the embedded option? Embedded option means we have seen the plain vanilla bond, plus if they have any option to call, or if they have option to put, or if they have option to convert. Convert basically it will not be an option. It is something like a contractual obligation, you can say. But anyways, so these options or this put option is given to the company and call option is given to the bondholder. So out of these three, not an example of the embedded option. You can also consider this one, con conversion. Okay. So this warrant, the moment a share warrant is with a holder, company cannot say, or it's not an option either to the bondholder or to the company, the share warrant will be executed only through the shares. It can't be executed or it can't be discharged. The liability can't be discharged by giving the cash. It has to be discharged only through the share. So there is no option to switch. The type of bond with an embedded option that most likely sell at a lower price other than plain vanilla bond, as we have seen it before, plain vanilla bond price will be more than a callable bond. Why? Callable bond is an opportunity, is an advantage to the customer. It's an advantage to the company. So if plain vanilla bond is issued at 100, company cannot issue more than, like, it has to issue at 98 because this $2 is towards a call option, what it is enjoying. Similarly, plain vanilla bond is $100. Always it will be less than the putable bond because putable bond is always on a higher side because this 2 rupees is paid, the premium paid by the bond holder. This is a $2 call option premium absorbed by company. Okay. So in this case, most likely sell at a lower than the price similar bond. So which will be sold lower than the similar bond? It is a callable bond. Without the embedded option, plain vanilla bond. Okay. The additional risk inherent to a callable bond is best described. Callable bond. So you have a period of 10 years, and at fifth year, company has called for your bond, meaning like they have paid and they have given you the money back. What instances, what situations they will be giving? Because the market rate is lower than what they are paying you currently. So the moment they gave you the money, the bondholder, the company gave you back to the bondholder. Bondholder once get the cash, and if he's going to the market, he'll be getting less interest than what he was getting it from the company. So interest rate risk, credit risk, reinvestment risk. So this is the right answer. Reinvestment, when he want to move with the reinvestment, so he'll not be getting the same set of interest rates. Financial instruments, the put provision of a putable bond. The put provision of a putable bond limits the risk to the issuer, limits the risk to the bondholder. So if I have a put provision, I can go back to the company and I just throw it on their face, right? So this will be limiting the risk of the bondholder. Assume that the convertible bond issued to South Africa has a par value of South Korea won. South Korea won. Okay, and currently price rate 101. So bond value, the amount what you have paid is $1 million, and now the bond market price is $1.1 million. Okay, the underlying share price is 40,000. $40,000 or won, sorry, won. Okay, conversion ratio is 25:1. The conversion condition for this bond is now for every one bond you'll get 25 equity shares. Okay, and the value, if you hold this bond, you go to the market and you sell it, you will get 1.1 million won. If you go to the company and if you convert into equity, you will be getting how many? 25:1, right? So every 1 million, so you will be getting 25 into 40,000, so which is something like 1 million wons. So your market value is more than your equity. So previously we have seen, if a market, if you are getting benefit, so upon making this conversion, this is not at parity, right? This 1.1 is not at parity, and you are not getting the benefit. So if your equity is going to be higher, then you should have got the betterment. So you are now going at a below the parity. The advantage what you are getting is a below the parity. Okay, we can do all these by calculations, but then we can also do the same by looking at the numbers. I'll show you how. Identify whether each of the following bonds is trading at discount, at par value, at premium. When a bond will be sold at discount if its coupon rate is 1% and the outside market is paying 2%. So obviously people will not be interested in buying your bond, the bond in your hand. They will be going into the fixed deposits, right? So when market reference rate is more or more than your coupon rate, then we can say it is selling at discount. Same way, if your coupon rate is more than the market reference rate, then you can sell it at premium. If they both are same, it will be at par. So now let us see this. The coupon payment per period, you are getting 2% while market is at 3%. So obviously you have to sell it at discount. You are getting 6% while market is only 4%. So obviously your bond has more premium value than other bonds. You can sell it at premium. You will get your coupon period is 5, your what you are getting is 5 and also market rate is 5. So obviously it is at par. This coupon payment, you are not getting any coupon, meaning it's a zero coupon bond. You are not getting any coupons, so it's a deep discounted bonds. Outside market is paying 2%. So you will be buying a deep discount. Okay. Then calculate the yield to maturities YTM. I'll be showing here onwards. I'll take the help of Excel to explain more better. Okay, let's switch on to the Excel.